Hey everybody, Chuck Barone. Friday, March the 24th, 2023. Wrapping up a nutty, crazy week on Wall Street. Crazy week for investors and working people like us. We're left here trying to figure out what in the heck is going on in this country. Anyway, before we start the show, as always, want to welcome everybody. Thank you guys for your support. You guys watching these videos and everything you do for the show every day. We couldn't be here without you guys. We appreciate it. Markets today. Well, this was the wrap up of a crazy week, so why not have a crazy finish, right? Stock market looked like it was going to have a pretty crummy day. Started the day down, went down further. Ultimately rallies back. I guess this Pollyanna kind of vibe the market has where everything's always going to be turn out okay. And I guess ultimately it will over the long haul. Comes back to this market. Rally at the end of the day. The Dow ending up 132 points. S&P up 22. NASDAQ up 36. Not any real data. Nothing really making these markets rise like that. I guess some people bargain hunting or what they feel like are bargain hunting. Lots of cash sitting on the sidelines, so these kind of weird rallies are not going to be unusual. Just too much uncertainty for a guy like me to be comfortable in a market like this. The bond market, well, the bond market is just gone off the rails, man. It's just crazy. So yields continue to fall today. The 10-year down just 2 basis points, sitting at 3.38. The 2-year dropping 3 basis points to 3.77%. So this yield curve now the inversion is really getting smushed together. You know, the 2-year Treasury has fallen 131 basis points in the last 12 trading days. That is, in the face of the Fed raising rates. So now, the entire yield curve, 2-month to 30-year, is lower than the overnight rate. Giving you an idea of what this bond market is right now. I guess the bond market's anticipating Fed rate cuts this year. They're calling now, futures, calling now for no rate increase at all in May and cuts starting in July. I don't see that happening, guys. That's what the market's betting. I would not be betting that way if it was my money in the market. Any kind of inflation shock at all turns this whole theory upside down on its head. And now we're going to see then bonds spike right back up. History repeats itself over and over. People just don't want to learn simple lessons, man. The dollar up today, rallies up. 100 back up over 103, 103.12 on the index, up 0.71 today. Nice day for the dollar. Dollar's still having a lot of strength in this against all these other currencies, even in the face of the euro raising rates. And the dollar was up, actually euro was up over 108 and change to the dollar, coming back down, but the dollar's still looking pretty strong. Metals today, I thought might have a down day, and ended the day kind of mixed with gold down today, $17.40, sitting at $1,976.10. I think this was more of any kind of just a technical correction. Resistance at the $2,000, those round numbers tend to be resistance and support numbers. I think that any second now, gold's cracking through 2,000. Any second now, and going to stay there. Silver actually rallies today, just a very small rally, up 2 cents, $23.11. $25 silver coming soon. Oil today down small, down 74 cents a barrel. $69.22 for a barrel of West Texas Intermediate. So it stays in that trough between 65 and 70. We're looking for a breakout either way. I truthfully say it's 50-50. It could break out to the upside. I still think downward pressure on oil. I think we're going to see this price come down to the lower part of the trough, maybe even break through 65. We'll see. It's kind of been in that range now for about a month or so. We'll see where it goes. Bitcoin today, down $412. 27,813 Bitcoin holding up. Reading a lot of positive press on Bitcoin itself. Other cryptos, Coinbase having some issues. Looks like they're going to have some SEC trouble. They arrested some crypto guy from Korea today. So there's some issues in that market, but Bitcoin holding up. News to wrap up the week today, guys. So let's see what we got. Cash. People flowing out of equities, out of bonds, out of funds especially, into money markets. $120 billion moving into money markets just this week. Currently $5 trillion with a T, dollars sitting in money market funds. Now, a lot of this is institutional. Obviously, the vast majority is institutional money, but nonetheless, investors going to consider, you're getting 5% in a money market. Why would you risk your money in a stock market behaving like this or a bond market behaving as crazy as it is? You can just sit on the sidelines, make 5%. I know it's less than the rate of inflation. Okay, I get that. But it's still a smaller loss than you might incur in stocks or bonds, right? And the dollar is still the medium of exchange. It's the vehicle we use to buy everything in this country and around the world. And until that changes, you got to be having dollars. Sorry, guys. So, adding 5% lock, no risk return on your dollars. In my mind, I think that's just an absolute no-brainer in an environment like this. Not a great time to be getting whipsawed around in stocks. If you're building a position, then you have a company you really like, it's in your town, or you know a lot about the certain sector or this certain company, buy these dips, build a position. That makes sense. But if you're trying to trade or actually just sitting tight on a retirement account in this environment, it's scary times, man. Crazy. But yes, anyway, as these rates continue to go up, we've talked about this on the show. I said somebody was going to lead the way. Back in the day, it was Dreyfus. We still haven't got a leader yet that's spiking the rate higher. It looks like they all are collecting depositors that way. And now they're actually competing with rate. So rates are going to continue to rise on those types of funds. Excellent news for investors who are looking for a reasonable return without any kind of risk. I was reading an article today, this is kind of spooky. As we know, with the Fed raising rates, a lot of the existing bonds that banks are holding, collateral, billions and billions and billions and trillions actually of dollars in these bonds, lost a lot of money as the Fed's been just raising rates. I was reading today that United States banks in the U.S. are sitting on losses that are unrealized losses, paper losses, value losses of $1.7 trillion. So that's the damage that's been done to their portfolios and their holdings, the money they hold in reserve, just getting smashed to smithereens as the Fed raises rates. That's why the Fed created this window to loan money on those bonds at face value rather than the reduced value they have in the market today. As you know, if you hold a bond to maturity, you're going to get the face value of that bond plus whatever rate was promised on that note or bond. So these banks are going to be forced to hold this paper longer than they wanted to, but nonetheless, at least they can borrow on that paper and not have to realize those colossal losses. Man, that is big, big money. And that's why the fear there is right now of runs on banks, because if they have to liquidate those assets, well, those are losses nobody wants to take. It was interesting, we talked about Yellen and Powell talking in the markets yesterday, trying to kind of walk back some of the spooky stuff they said the day before, right? But the truth of the matter is, guys, there's a credit crunch coming. Lenders right now across the board, from car loans to mortgages to personal loans, tightening standards, making loans more difficult to get, especially for people who have lower credit scores, less history payments, less free cash flow, tougher now for borrowers to get money, but nonetheless, borrowers loading up on high interest debt, credit card debt, record numbers. Average credit card interest rate now 20.4%, Matt. That is just silly. Do not borrow money at 20.4%. Okay, guys, please don't do that. This is, borrowers loading up on debt right before a recession. And lenders tightening standards. We talked about this before too. You're going to see people's credit limits getting chopped. That already has started. I've had some viewers responding to that, talking about how theirs were cut. This is just the start of it right now. And anybody thinks that we're out of the woods as far as this bank stuff and the inflation fight and all of this stuff is just going to magically go away, or we're just going to, somehow or another outlast it all, and it's just going to take time. That's just magical thinking, man. We need coordinated action. We need some people who know what the hell they're doing. We need to have the ability to fail without one side or the other completely ravaging you, because we have to try some stuff that may or may not work, right? But there's no success without failure. Nobody makes 1,000 out of 1,000 shots, okay? So if you don't see failure, what that tells you is nothing's being done, nothing's being tried, right? So credit crunch coming. Personally, I think it's going to be okay. I think it's time for consumers to start learning to live a little bit less without debt and credit. We've been preaching that nonstop on this show since the very first day. And hopefully, if you've been listening to what we've been saying, 20.4 interest, 20.4% interest on a credit card isn't something interesting for you to hear, but it's not affecting your wallet. It's not affecting your monthly budget. It's not affecting the payments you're making. That's where we want to be in this show. So, in wrapping everything up, another crazy week. Extra crazy, it seems like this week, right? So what did we get this week? We got more bad news on banks. Credit Suisse gone. First Republic bailed out by other banks. Still looking super shaky. Deutsche Bank now, they're the latest that everybody's talking about, looking super shaky. So this banking thing is not going away. At the same time, we got the Treasury Secretary, Miss the awe-inspiring Janet Yellen, and St. Jerome of Jekyll Island, the doer of miracles, out there telling us and reassuring us that everything's great with banks. Who believes that, man? Anybody? We got another rate hike this week in the face of the bad news we got on banks, which is a pretty clear indication that the Fed either A, doesn't believe there's an issue with the banks, or B, is more interested in fighting inflation than they are keeping the economy and these banks afloat. So that was really interesting and kind of certainly sends a message. We get a super hot jobs report, so we know the jobs market is still going. Even though they're not great jobs, there's still a lot of openings. Wages are going up. We know that statistically is happening. So that's not great news. At the same time, the consumers, record-breaking now numbers as far as what they owe on their credit cards, the payments they're making. We got default coming like crazy on loans, auto loans, especially subprime auto loans. Defaults picking up steam, accelerating. You got investors flying out of the stock market, dumping mutual funds, dumping bond funds, and going to the safety of money markets. $120 billion in a week. You got real estate completely still in the crapper. now really being pressed for inventory. As sellers reluctant to sell, why would they? Prices coming down with rates up. Not a lot of incentive there for sellers to sell, because even if they're downsizing because of the way rates have gone up, they're going to have a bigger payment on a smaller house. Why would they do it? Why would they change? So now I'm just waiting now to see the camel staggering, let's face it, which is going to be the straw that breaks the camel's back. Will it be monetary? Will it be a mistake by the Fed? They go too far with rates, they don't go far enough. Will it be fiscal? The government, our geniuses in Washington, who are going to fight over a debt ceiling, will they default? Crack up the whole financial system across the world? Is that going to be what breaks the camel's back? Is it going to be geopolitical? War? Our enemies? Certainly more functional than we have been. Is China, maybe China goes to Taiwan. Maybe something we're not even expecting. Maybe somebody we think is on our team joins the other team. Maybe somebody desperately needs to avoid sanctions and needs a piece of that Russian oil or gas. I mean, there's so many things that could happen that could finally be the match that lights the fuse, the straw that breaks the camel's back, whatever cool cliche you want to use. That is coming, guys. So save your money, man. Hold on tight. Learn to live on less than you make. If you can do that, if you can learn to do that, that's the very, very first step in building real wealth, okay? If you can learn to do that, the recession isn't really going to do much to you. It might change some of your choices, but it's not going to change your lifestyle. It's not going to be a cataclysmic financial event. So get started, man. Anyway, I babble. Hopefully next week we'll have some good news. I'm going to start changing that website around next week. I'm going to put up, what I'm going to do next week is I'm going to show you how I play the market right now. I'm going to just have a straight up investment in the S&P 500. I'm going to buy it at Monday's closing price. I'm going to invest a mythological $10,000 just to show you guys the percentages I would have in the market and not, and how I would play that market. You can follow it any way you like. That'll be there on Monday. In the meantime, weekend, Friday, time to have a great weekend. Let's get away from the crazy. Let's get away from the political. Let's get away from money. Let's enjoy the time we have with our families and our friends. Spring is in the air, at least here in Vegas. It's get a little sunnier today and a pretty day outside. Hopefully the weekend will be the same. You guys go and enjoy yourselves. Take care of yourselves and your family and each other until Monday, when we start a whole new week of crazy. Have a great weekend. See you Monday.